Behind every retail product stacked on modern supermarket shelves lies a 12,000-ton steel container that crossed the open ocean for pennies per mile. Global maritime shipping lines form the literal circulatory system of international trade, moving over 80% of all manufactured goods across the planet. Building a fleet of ultra-large container ships requires capital expenditures that rival sovereign defense budgets. A single modern 24,000 TEU container vessel, capable of stacking 24,000 20-foot metal boxes across 24 vertical decks, costs upwards of $250 million to construct in specialized shipyards. To finance these massive floating skyscrapers, container shipping conglomerates leverage long-term shipbuilding loans backed by government export-import banks and institutional capital. The financial model of ocean freight is governed by sheer scale economies. The larger the vessel, the lower the per-container transit cost across transoceanic trade lanes. However, owning a shipping line means navigating extreme volatility, where global freight spot rates can swing from $2,000 per container to over $10,000 overnight based on geopolitical shocks. Once a mega-container ship is launched, its operational economics are dictated by fuel consumption, route optimization, and port turnaround times. A single vessel burns hundreds of tons of heavy marine fuel oil or liquefied natural gas every single day, while steaming across ocean basins at 24 knots. Fuel costs represent the single largest operating expense line item for any shipping line, frequently consuming up to 50% of total annual operating budgets. To mitigate volatile fuel expenses, shipping executives utilize complex fuel hedging contracts and slow steaming strategies, reducing vessel cruising speed by 2 or 3 knots to slash fuel burn by over 30%. In port, every hour a vessel sits idle at a container terminal costs tens of thousands of dollars in charter fees, gantry crane tariffs, and berth occupancy charges. Consequently, shipping lines invest heavily in automated container terminals, predictive berth scheduling software, and proprietary logistics algorithms to ensure ships unload, reload, and return to sea within 24 hours. Beyond physical vessel operations, container shipping lines monetize their networks through long-term service contracts and ancillary intermodal logistics services. Instead of relying entirely on volatile spot market freight rates, major carriers lock in 70% of their cargo capacity through multi-year service contracts with global manufacturing giants and retail conglomerates. These contracts guarantee baseline cash flow regardless of economic downturns. Furthermore, modern shipping empires have evolved into integrated supply chain operators by acquiring land-based logistics assets. Carriers now own and operate entire intermodal ecosystems, including rail freight networks, regional trucking fleets, inland container yards, and automated port-adjacent distribution warehouses. By controlling the entire door-to-door supply chain from an Asian manufacturing factory floor straight to a Western retail fulfillment center, shipping lines capture high-margin auxiliary fees at every single transfer point. Operating across international waters exposes maritime shipping lines to severe geopolitical risk, naval choke points, and environmental regulations. When regional conflicts or maritime security threats close critical trade arteries like the Red Sea or the Suez Canal, carriers are forced to reroute entire fleets around the Cape of Good Hope. Rerouting around the African continent adds thousands of nautical miles and 2 extra weeks to transit times, burning massive reserves of extra fuel and tightening global container equipment supply. In addition, international environmental bodies enforce strict carbon intensity reduction mandates, forcing shipping lines to retrofit legacy fleets with exhaust scrubbers, shore power connections, and carbon-neutral green methanol propulsion systems. Investing in zero-emission green fuel retrofits requires multi-billion-dollar capital outlays, separating elite, well-capitalized carriers from vulnerable regional operators. To survive brutal freight rate down cycles, the global container shipping industry has consolidated into massive operational alliances. Carriers pool their vessel fleets and share container space slots across shared global routes, allowing them to maintain high sailing frequencies while optimizing cargo fill rates. This alliance structure prevents destructive price wars during periods of oversupply and protects corporate balance sheets. Ultimately, owning a global maritime shipping line is not about moving steel boxes across water. It is about controlling the vital veins of global commerce, where economic survival depends on absolute scale and ruthless operational efficiency.